And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Monday as we kick off another week of September. We're getting ready to wrap it up. Today's also my youngest daughter's, today's her 19th birthday. So happy birthday, Mackenzie. So she's up in Baylor today, freaking out. Just had her first test come back. She made an 80. Now you say, for her it's a disaster. She's never not made like 100 on anything in her entire life. So she called up, she goes, I'm thinking I need to switch majors. And I'm like, honey,
just one test.
It's your first test in college. And she's like, well, I studied everything they gave me. And all the questions were different on the test. I go, yes, because now you're in college. You're no longer in high school where they teach you the tests so you can pass the test so they get their funding, which has always been the problem with our kids. We don't teach them.
Whole other ball
we
of wax.
don't teach them to think cognitively, right?
Yes.
Well, now that she's in college, she's got to start using logic, and so she's got her first taste of college life.
How the real world works.
Exactly. So anyway, she's got it. Don't worry, she'll be fine. Trust me, she'll be just fine. But because she's very conscientious. But it was very funny.
Doubts.
It was very funny. My wife and I just belly rolled over this one. So anyway, so a couple of things happened over the weekend. Donald Trump announced a potential deal with China over TikTok. We'll see there's still a lot of details to get worked out, but basically the crux of the deal is that the data and the algorithm will be stored in the U.S. And it looks like right now that, according to just some of the articles I read, that Oracle will be the company that basically houses the data and the algorithm and controls that. Not Oracle directly, they'll just be housing, they'll be the company providing all of this infrastructure for TikTok. There's a couple of rumors right now about who will actually kind of be making the acquisition. One is the Murdoch family. The private equity companies, Sequoia and others, they will continue to hold their equity stake in the business. So again, but a lot of details coming out, but this has been kind of the big thing over the last few years has been about national security with TikTok, all of the U.S. user data being stored in China. So this deal will eventually bring this back to the United States. So all of the data, the algorithm, etc., that is all around the U.S. user base. Now this is around the U.S. user base, not the global base. Just the U.S. user base will be housed in the U.S. Now, what that means is that China won't have access to your data to do whatever they want with it, but the U.S. government will. So at least you're safe, right? That's kind of the point.
I've got one question about the algorithm, too. Are we going to now start seeing more cerebral content instead of cat videos?
No.
Okay.
You will actually get more stupid content now that you have control of the U.S.
It's just the worst.
Exactly. Well, that's social media. There's lots of problems with social media. We can have a whole discussion on Two Dads on Money about the ills of social media, but yeah.
Well, you and I are out of the demo anyway.
Well, correct.
Yeah.
We don't understand that stuff. We're on Facebook.
Kids these days.
The kids these days. But anyway, so that was kind of the big news over the weekend. This morning, markets are continuing to perform okay right now. Just again, as we just kind of look ahead, we're about to wrap up the month of September. We just went through options expiration on Friday. And by the way, Friday was an interesting day. The market was selling off pretty good. We opened up Friday morning, market was selling off pretty good. Then that news about the TikTok deal happened around 10 o'clock Central Standard Time. And then the markets just rallied back to all-time highs for the day. So again, what that had to do with anything, probably nothing. It was just really more options expiration on Friday. A lot of volatility occurs on Fridays when you have very, very large options expirations, which is what happened on Friday. But this morning markets are still just we're kind of in that place where markets are doing okay. And we're going to discuss a little bit more this morning, talking about the bullish and bearish case for the market. Scott Rubner from Goldman Sachs had a really good piece lately, so I kind of took that as a base and then kind of wrote a structure around that, just discussing kind of where we are right now in the markets. Understand that, yes, the markets are very bullish right now. It will end, right? We will have another bear market. Now, I'm not talking about a financial crisis. So when I say bear market, I'm not talking about a financial crisis. But we'll have a market like 2022 where the markets are down 15, 20, 25% a year, and it doesn't recover. I mean, like you actually end the year down 20% for the year. That's going to happen at some point. All bull markets eventually end in a bear market at some point. Now, that's a good thing because it resets all these concerns about markets, valuation risk, equity risk premium, all that gets reset during a bear market, and you have an opportunity to put capital to work at better prices. But again, that's not where we are today. And here's what you need to know before the bell this morning. Markets continue a very elevated advance here. Again, as we've talked about previously, the market dynamics remain extremely bullish right now. And we have a very sharp angle of ascent. And now there's nothing wrong with a sharp angle of ascent, except it's hard to maintain that over the longer term. But this kind of very accelerated rate here is just the consequence of a lot of money flooding back into the markets. Retail investors have been spending about $4 billion a day on stocks. They've actually just been a big contributor to the overall market advance as of late, along with share buybacks, corporate share buybacks, which are also running at about $5 billion a day. So you've got a lot of capital flooding into the markets on a daily basis. And again, that's not a bad thing. It's not a good thing. It's just what it is. But again, when we start looking at, kind of extensions and deviations, you do have very, very big deviations from long-term moving averages. Eventually, those deviations always correct. We had a very big one here. You had this correction. You're eventually going to retest these averages. Again, when these things occur, you always get these reversions back to the mean. It's just a function of gravity. But in the midst of the moment, as markets are rallying and kind of where we are now, it certainly doesn't seem that way. This market's just going to keep going up forever. And it certainly seems that way right now. But again, this is where risk is building in the market. Now, what eventually causes a reversion, who knows, right? Again, it could be a change in the political environment. The Fed comes out and says, hey, you know what? We cut rates once, but we think we're done for now, right? The markets are expecting 4 more rate cuts between now and next year. Lots of exuberance in the market. So when you have a lot of exuberance in the market, it doesn't take a lot to reverse that, particularly when you've got very, very overbought conditions of momentum and relative strength as well. Oh, by the way, this is a weekly chart. So it's much slower to move. To get these types of overbought readings on a weekly basis is a bit more difficult to do. And historically, when you've had these bigger overbought conditions, you do get corrective phases. Again, it doesn't have to be huge corrective phases. Again, some of these were a lot smaller. You were just running along the 20-week moving average. But you can get a 3, 4, 5% correction pretty easily when you have these kind of overbought conditions. But you're also set up for much larger corrections as well, like we saw back in 2021 going into 2022 was this is the 2022 bear market right here. But again, you had this a very similar extended overbought condition in 2021 that you do today. And again, same type of exuberance, same type of risk on attitude, no concern about market corrections. Remember, 2021 was very exuberant, SPACs, meme stocks, all that was going on. Everybody thought, hey, this market's just off to the races, it's never going to end. And then 2022 comes along, the Fed starts hiking rates, you have Russia. Those things happen. And that's exactly the same setup that we've got right now. We have this very exuberant market where nobody thinks anything can go wrong, which is exactly the kind of environment that you need for a correction to occur. So it doesn't mean to go out and panic sell everything today. That's not what I'm saying. But you just have to understand that the risk is there. Could this market continue to advance through year end? Absolutely. Could there be a 3 to 5% correction between now and the end of the year? Absolutely. So again, just keep those things in mind as you manage the risk profile of your portfolio. Just be careful. And particularly in a market like we have right now, where markets are being driven by a really much smaller handful of stocks, kind of big financial banks, the kind of the mega cap, AI stocks, etc. the rest of the market's doing okay, but it's not doing fantastic. It doesn't look like this, right? So just be careful with that risk, and particularly when you're chasing a lot of various asset classes that all have a very similar overbought condition and overbought structure as you do in stocks right now. So again, that's what you need to know before the bell this morning. We'll come back, talk about the market bull case versus bear case. Don't go away.
Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Back to the show this morning. So a couple things just to kind of think about. It's like, when, as I was just saying a second ago, you've got to be careful with markets when they're very overbought and extended, because those provide the catalyst for a corrective environment when or if it should occur. And again, I should say when or if, but it will occur. We will eventually have a downturn in the markets caused by some event, whatever it is. And it's just simply anything that causes the expectations of the markets to change. Again, at the end of the day, all that matters for markets is forward earnings. So right now, everybody's kind of ratcheting up forward earnings. They're ratcheting up, today Goldman Sachs just raised their forecast for the end of this year and next year. Their previous forecast was that the S&P 500 would hit 6,600 by year end. Well, we closed Friday at 6664. Now, that was actually interesting because on Friday we hit 6666. Why is that important? Because the market bottomed in March of 2009 at 666. So you're basically up 10,000% since the end of, I'm being facetious, right? But you've gone up 6,000 points since the market bottomed in 2009. It is the strongest bull market in U.S. history, just to put some context around it. So you've had just a fantastic run in markets over the last 15 years. That eventually ends, but it doesn't mean it ends today. Doesn't mean it ends tomorrow. You've had some little bumps and hiccups along the way. You had the pandemic, and you had, 2022. You've had some, 2018. You had a 20% correction. You've had some bumps and bruises along the way, along this really major bull market advance, this rise of 6,000 points. It's fantastic. But again, just as with all bull markets, all right, and we had a very similar bull market from 1980-ish, early 1980s, all the way through 1999. Had a couple of bruises along the way. You had the long-term capital management, Asian contagion. You had Orange County. You had what else? Oh, the 87 crash. Can't remember the 91 recession, and the markets just kind of kept on rising, right? So you get in these periods where you have these very strong bull markets. They all eventually end. Now, what caused them to end, as I said earlier, we don't know. But in the heat of the moment, it's where we get all involved with, there's nothing that can stop this market. There's absolutely nothing going to make this market go down. And it certainly feels that way. And it doesn't mean that it's going to happen tomorrow. And I'm not saying that it's going to happen tomorrow. That's not the point of the conversation this morning at all. The point of the conversation this morning is simply to talk about what the kind of the layout of the cases are on both sides. And this is kind of the point of the article. It's on the website right now, realinvestmentadvice.com. It's called The Markets, Bullish versus Bearish Case. And so we'll just kind of get into it. I'll share some charts with you this morning. But Scott Rubner of Citadel Securities wrote a really great piece, I think it was on Friday, and I was reading it over the weekend. And he was kind of discussing this bull versus bear case, really much more. So Citadel Securities, let me back up for a second if you don't know who Citadel Securities is. Citadel Securities is a massive hedge fund. They do a tremendous amount of market making, kind of behind the scenes. And when I say market making, I'm not talking about bringing companies doing IPOs. I'm talking about they basically manage order flow. So, for instance, whenever you buy something on Robinhood, as a good example. Robinhood doesn't really execute the trades for you. They have a relationship with Citadel Securities who handles the trade execution. They're kind of simply a pass-through. So the reason that you can buy stocks with no commission anymore, right, is how do we get around the commission? You know, people have to make money, right? So if I'm going to execute something, I've got to make money. How do I get around that? How do I not charge you a commission but still make money? Well, it's called payment for order flow, and we've written some articles on this. If you go to our website in the upper left-hand corner in the search bar, just type in payment for order flow. We've written some articles about it. There's nothing wrong with it, right? But it does take advantage of retail investors. The prices you think you're getting are not as good as you're getting. And if you actually go and do the math, you're actually better off paying a commission than you are getting free trades. There's no free lunch on Wall Street. Somebody's making money off somebody somewhere. So when you place an order at Robinhood, now this happens very quickly, mind you. It's happening, and this is happening in nanoseconds because there's enough activity on Robinhood that they can do this. But they accumulate orders, and so let's say you go to buy, Meta stock. And you're looking at the price on your screen, you go, oh, I'm going to buy it right here. I'm going to buy it at this price. And then the price you get back is different than the price you got. Well, it's what's happening behind the scenes in the matter of seconds is that they're accumulating a large number of these orders, and then they sell them. Basically, they sell that order flow to Citadel Securities, who can work that trade, and Robinhood makes money, and Citadel makes money, and you get your position. But somebody's, and again, is always the case. You're paying somewhere, and sometimes a little bit more transparency is better. Just pay the $5 commission, whatever it is. You would actually be better off. But a whole nother conversation we'll have for another day. Anyway, that's who Citadel Securities is, and they're massive. Anyway, so Scott Rubner wrote this piece, and when you look at the markets today, in particular, and see the tension between expectations and reality, it's the one thing that kind of gets you to step back and go, okay, well, let's think about this a bit. It goes on one hand, and this is particularly when you're talking about equities and particularly tech and growth, those are all pushing all-time highs. We just had, I posted a chart this morning on X. We have the highest level of beta momentum chase right now going on. In other words, people buying high beta stocks, the largest amount ever on record in the last month. It's just been crazy how much. As I said earlier, you got $4 billion a day from retail investors piling into the markets. You got optimism about rate stocks. You've got AI and productivity gains, global monetary easing. Right now, you've got central banks have cut rates 88 times before the Fed cut rates last week. So you've got global easing going on. It's not just the Fed cutting rates here. The Fed is way behind the curve in terms of every other central bank in the world, right? Every other central bank has been slashing interest rates, and the Fed's now starting to play a little bit of catch up here. So you've got this global monetary easing, and you certainly got, earnings have been okay. They've actually been good. On the other side, you've obviously got some concerns. You've got growing valuation concerns. If Warren Buffett actually paid attention to market cap to GDP, I'm not sure that he would have already had a heart attack, because that thing is just off to the moon. So valuations are high. Inflation remains sticky, right? It's coming down, but it's not dropping like a stone, which is a good thing, by the way. You don't want rapidly declining inflation, because if you had that, we would be in a much worse economic environment, and that would not be conducive to earnings growth where they are. So actually having some sticky inflation here is actually good for the stock market because it's helping maintain earnings growth. Growth outside just a few sectors, being technology, financials, and health. Discretionary and communications. Outside of those sectors, growth is slowing. And of course, you got investor positioning their extremes. And so when you start kind of looking at this bull case, bear case, right, it's easy to kind of migrate over to one case to the other. And this is what we do as investors, is like, oh, we like the bull case, so let's just go with that, because I'm going to just focus on these issues, rate cuts, earnings growth, those type of things. And there's certainly some very strong support there for the markets. But we ignore anything that, kind of contradicts that case. And this is what we call confirmation bias. So we only read stuff and we only look at stuff that supports our case. The bear case has some good, solid foundation to it. That solid foundation will eventually matter. It just doesn't matter today, right? And so at the moment, you've got this kind of break between, or this argument between market factors. And investors are choosing their battle. I've got, you've got one group of people. I just got an email this morning from a gentleman, and he's like, I just can't see myself investing in this market at these levels. It just doesn't make any sense. Problem is that these levels can get more of these levels for the next few months, into next year, maybe all through next year. It can last a long time. Doesn't mean you're not going to get some little bumps along the way, 3-5% corrections, that's going to happen. But, having a more corrective action that will allow you to say, okay, well, I can now invest because valuations got cheap, that's probably not going to happen anytime soon. And so here you are kind of stuck on the sidelines waiting for this correction to occur. And then when it does occur, you probably won't buy anyway, right? You just had a 20% correction in April. And how many people that were sitting on the sidelines bought the bottom in April? Not a lot. If they were concerned about the market being overvalued, extended, whatever it was back in March and April, you have a 20% correction. You've got a great opportunity. You got consumer sentiment extremely oversold in April. On April the 7th, we had not seen such extreme negative sentiment by retail and professional investors since October of 2022, where the market bottomed. So if you were concerned about valuations in March or April, you probably didn't buy that bottom. You're probably saying, oh, finally the correction's here, right? The crash is coming. I'm just going to sit back and wait and eat my popcorn and wait for this, this market just to peel apart. And it didn't, of course, just April 7th, that was the bottom, and markets took off again. So that's the problem with, for investors, of being all in cash. It's very, very hard to get into the markets. It's very hard. And so this is why we talk about, you've got to just kind of get in the markets and then, kind of got to get in the water and then just swim and navigate the risk as you go. It's just because it's so hard to get in. But again, that's just kind of where we are. So we're just going to let me just go through a few things this morning with you, just talking about this bull case and the bear case in general. So let's talk about the bull case first, which is where we have a lot of optimism. And optimism has a force to it. There is a tangible force. It's called sentiment. And when people are very bullish, they disregard risk and they keep buying. What makes markets go up? Buying. And as I said earlier, $4 billion a day from retail investors, $4 or $5 billion a day in stock buybacks. We have stock buybacks running at the highest level we've ever had on record right now. So that sentiment is a real force for the markets, because the sentiment is what acquires the capital to drive asset prices higher. And when you talk about valuations is a good example. Valuations in the short term, over the course of a year or two or three, is all about sentiment. I'm willing to pay more for stocks today because I believe ABC about earnings growth. And that's fine. That's all there is to it, right? So sentiment drives valuations in the short term. Now, when you start talking about long-term valuations, talk about, CAPE valuations, those type of things, that has everything to do with forward earnings because you're taking 10 years worth of earnings data and smoothing it by using an average. So that's why valuations, long-term valuations like CAPE 10 have a very high predictive rate of forward returns because of that smoothing, that averaging of a 10-year span of earnings. But in the short term, it's all about sentiment. This year, next year. I'm willing to overpay for stocks today because I think earnings are going to grow more next year. And that's going to justify the valuation I'm paying today. That's my sentiment. So I'm willing to buy stuff which drives up prices and valuations, right? But here's a chart of, we're about to go into quarter 3 earnings. And just talking about earnings sentiment right now. So this is a chart of quarter 3 earnings estimates from S&P. And that big crash that you see in earnings estimates, that was the expectation when this was the day that Trump comes out at the Rose Garden. He holds up the big sign and he says, here's all the tariffs that we're going to impose on these companies. And then the next day, S&P goes to earnings. And then that bottom is April the 7th, where Trump comes out and says, oh, never mind, we're just going to do 10% tariffs on everybody and we're going to work these deals out over time. And S&P goes, oh, okay. Here's where we think earnings are now. And so estimates jumped up. But you'll notice that if you take out that big spike lower, it kind of skews the chart to a large degree. Earnings estimates have been coming down for this quarter for quite some time. We've been slashing earnings estimates as we come into the quarter. So, we started out expecting $243 a share in earnings for the S&P 500. We're now down to $232. So we've clipped off $11 of earnings, even though the market price keeps going up. So this is why valuations keep rising so sharply. We keep cutting the E as the price keeps going up. I'm going to go to the next chart, Brent. But this next chart is the logarithmic scale of earnings going back to 1900. Now, here's what's important about this chart. We're currently above the long-term trend. Now, so the middle dash line, that orange line, that's the long-term earnings growth trend for the market. What should be evident, and what is evident, is that earnings both expand and contract over time because of recessions, economic slowdowns, whatever it is. And so earnings kind of travel within this channel over time, which corresponds with economic growth. Right now, earnings estimates are so far deviated above that long-term exponential growth trend. In fact, it's the largest deviation from the long-term exponential growth trend ever on record. We've never had earnings this deviated. Now, forward expectations into next year are $278 a share. That is above the top of the long-term trend channel of earnings. Now, those are all going to get revised down, right? We're going to wind up next year at, 230, 240, somewhere around there. Because we'll again, when you're taking out $11 a quarter, $11 times 4 quarters, or just say $10. Let's say we revise earnings down from here, just $10 a quarter. Well, that's $40. So clip $40 off, 278, and you're at 238, right? So 240. It's still elevated, right? But you're going to pull it back inside that trend channel. But that's what but what I'm talking about right now is that this is the expectation that's driving the markets. Analysts are so optimistic, and now then what's happening is everybody looks at these and say, oh, well, if earnings can grow at 20% a year, I can overpay for earnings. And so that's what's happening. And as long as earnings continue to grow, investors can be somewhat justified in their purchases. And as I was saying a second ago, we've got just this massive purchase of corporate buybacks. So reason 1 is earnings growth. Reason 2 for the bull case is these stock buybacks. This is the announced share repurchases this year. And you are running at a rate that is far higher than the 3-year average, which is one of the reasons. And if you'll notice, those buybacks were kind of running at the average pace until April the 7th and then exploded. So it's been one of the big drivers of the market. Again, when you're just pumping in $5 billion a day into the markets, that just helps lift asset prices. So not surprisingly, but as I said, retail demand has been absolutely off the chain in terms of exuberance. This is the blue line, or the blue bars, is the average retail net demand by month on average from 2020 through 2024. So that 5-year span. The gold bars are what's going on right now this year. So retail demand has absolutely just kind of left the station in terms of buying. So you've got this massive surge in corporate buying, this massive surge in retail buying, which is all helping support. Again, what do you need for a bull market? You need demand. You've got to have investors willing to pay a higher share price, because you have to entice a seller to sell their shares. You've got to give them a price high enough to say, okay, yeah, finally, I'll sell you my, Palantir here. I'll sell you my Apple here. I'll sell you my Meta here, whatever. So you've got to give me a price high enough to get me to sell you something, because you got to have a buyer and a seller. So the more demand there is, the prices keep going up in order to bring sellers into the market. Question is just, when does that eventually end? This is also another version of retail investing. This is don't get too involved in this chart. I'm going to explain it to you because it's a little bit convoluted. But the difference between institutional and retail buying is tracked by what's called odd lots. Institutions buy round lots. So when I go in to buy shares of something, right? So if we're going to go buy ExxonMobil, we look across our board, we see all of our clients that need to buy, ExxonMobil, and then we'll go buy, 50,000 shares of ExxonMobil, and then we'll divide those shares between all of our clients, right, on a pro rata basis, depending on their allocations. So we're buying big lots. We're buying big round lots of stock, and that's where institutions play. They come in, they buy 100,000 shares, 1 million shares, whatever they're buying. They're just buying big round lots of stock. Odd lots are shares less than 100, or the number. Sorry, let me rephrase that. Odd lots are when people buy less than 100 shares. That's typically what you see by a retail investor. You go buy 5 shares of Nvidia or 40 shares of ExxonMobil. So anything less than 100 shares is typically called an odd. That's called an odd lot, and that's typically where retail investors live. That is now accounting, those odd lots are now accounting for 60% of the total trade count and 20% of the notional volume. So the whole point about this is retail investors are playing a very important role in the current market advance. And that's an important support for the bullish case. So we've got several things. So let's just recap really quickly. Drivers for the retail case, or for the bull case, is earnings growth continues, right? Still expecting earnings to grow between 6 and 20% over the course of next year, depending on which firm you look at. You got retail investing and corporate buybacks. So you've got a lot of money flows coming into the market. So a bullish scenario is also supported by the expectation for 2 to 3 Fed rate cuts. Also, inflation continues lower at a slower pace, which is good for earnings, good for corporations, good for the consumer, right? The economy's not falling off a cliff. That's good. That means people have jobs. Global trade frictions are easing, right? We're kind of getting past this whole tariff stuff that we had going on. Again, earnings continues to rebound here, and liquidity stays plenty abundant between retail investors, between corporations, institutions, pensions, etc. Plenty of liquidity in the markets. Let's talk about the bear case. Bear case has some teeth, and you can't really dismiss the bear case, and you should at least consider it in your analysis. I mean, the bull case is good right now. And again, when you look at the bull case, there's not anything showing a slowdown in the buying of the market. So again, the bull case is here. It's valid. Suggests that asset prices are going to go higher near term. Near term. But longer term, the bear case has some teeth. Valuations obviously being an issue. Here's a chart of valuations. This is forward and trailing estimates based on earnings. So we're currently trading about 22 times earnings on a forward basis and about 25 times earnings on a trailing basis. CAPE is around 33 right now. So 25 times earnings is not a record, but it's certainly pretty elevated. And it's certainly elevated at the point where valuations are a concern. Last time we were kind of up at these levels was, 2022. And then previous to that was kind of heading to the dot-com crisis. So you're certainly elevated in terms of valuations. And valuations matter because when you're in the top 5% of valuations and all throughout history, markets tend to revert from those levels at some point. Again, you can't sustain these valuations at these levels forever because, again, valuations are important to forward returns. But high valuations, as I said, high valuations are a function of sentiment in the short term. This is all about sentiment. This push higher in valuations is all about sentiment. High valuations mean expectations are high. They reflect investor sentiment. But the risk you run is earnings disappointment. What if the economy slows down more than expected? What if the consumer begins to back up a bit? What if the demand for AI is overestimated? What if the expectations for productivity gains over the next couple of years are overestimated? It's very easy to overestimate these things because that's what happens in markets. We begin to extrapolate these ideas and go, well, but, I was only expecting 5%, growth in earnings. But, if we get productivity gains, so, well, now we can get like 7%. Well, what happens if you don't get the productivity gains you're expecting? And then, well, based on that case, if I get, 5% increase in productivity gains, but what if I got 7? Then what would that mean, right? And so we start playing all these games with ourselves. And our expectations run well ahead of reality, and then that's what typically comes back and kind of bites the market in the butt. And this brings us to our next chart, which is talking about earnings versus economic growth. You'll notice that there's a very high correlation between the year-over-year change in earnings versus economic growth. Economic growth is slowing from where we were previously. But you'll notice right there at the tail end, where kind of my mouse is sitting right now, there's this kind of big gap between what's going on with the year-over-year change in earnings versus what's happening with GDP. GDP is declining, but yet we're expecting these earnings to continue to go up. We've had these types of deviations before, and earnings tend to catch down with GDP, not vice versa. So it's at least worth considering that unless we are about to get down, and this is what analysts are expecting right now. Analysts are expecting that this economic slowdown that we're seeing as of late is only temporary, and we're about to have a reacceleration in economic growth. That is coming from the idea that AI is going to provide this massive boost to the economy. Maybe that's the case. But there's a dark side to AI and this whole development, kind of this productivity gain base, which is employment. So we'll see who works out. But that gap is something at least worth paying attention to in the near term, because that gap typically can exist historically, and we've just seen that, kind of return over time. The other side is equity risk premium. We've got extremely compressed equity risk premium right now. And, this is the extra yield that investors demand for owning stocks over other safe assets. And that is very thin right now. Bonds and risk-free rates are relatively more attractive than we've seen in previous past cycles because of where they're traded right now. And this is something extreme worth paying attention to, and I'm going to read you a quote. This is from Callan Thomas, which is a smart guy. And he wrote a piece about this, and I thought his quote was excellent. The prospective equity risk premium based on expected returns is negative, and the equity risk premium indicator from the Shiller data continues to track around 20-year lows. All the warning signs are there, and we need to be paying closer attention to opportunities in bonds and risk in stocks. And the next logical step for asset allocators is being a switch to underweight stocks and overweight bonds. And he's absolutely right about that. Lastly, again, this all comes down to earnings growth. To economic growth. Everything hinges on economic growth. The leading economic index has turned lower again recently. And the economic composite is tracking at below zero right now. Again, when we start taking a look at broad indicators of the economy, they're not suggesting a broad economic resurgence, and consumer confidence remains mixed here at best. Discretionary spending is under pressure from inflation, stagnant real wages, rising debt burdens, which, the most important driver of the markets ultimately is the consumer, because they're the most important driver of economic growth. That could put the market at risk. Earnings for small and mid-cap stocks have already shown some cracks. They're much more sensitive to tighter financial conditions. Even though the Fed's starting to cut rates, it may be a little bit too little, too late for a lot of these companies. Again, about 40% of these companies are non-profitable. So if the economy slows down, they're very much at risk. If we have we have a market where we have a narrow set of large cap tech winners and kind of large cap financials, and really when you take a look at the sector market breakdown, right? You have discretionary, communications, technology, and finance driving the markets. Everything else is not really pushing the market at all. But let's talk about discretionary, communications, technology, and finance. In discretionary, it's basically two stocks: Amazon, Tesla, Mag 7. In communications, it's basically one stock: Google, Mag 7. Take a look at technology. It's primarily NVIDIA, Apple, Microsoft, Mag 7. In the banks, finance, it's JP Morgan, Wells Fargo, Bank of America. It's basically a handful of BlackRock, right? So basically about 5 major banks. That's your market. That's not a broad market. Even though you got 4 sectors driving the market, they're driven by basically a handful of stocks. That's the risk that we currently have in the markets. And lastly, you can't dismiss the kind of external macro risk from ongoing trade policy, geopolitical potential flare-ups, fiscal policy uncertainty. We've got a lot of stuff going on, and with Congress and spending and debt to deficit and GDP concerns. So we're about to have another debt ceiling issue coming up. We're going to have to deal with that. We'll get another continuing resolution. Possible disruptions from China. I mean, you just got a lot of other stuff going on that could disrupt the markets unexpectedly. And the higher the greed factor is in the markets, and the more complacent markets are, the easier it is for one of these macro events to actually disrupt the markets. It creates, this very high level of complacency, this very high level of asset ownership structure, this bid to buy everything going up, makes the market actually more fragile. Because as we talked about before, there's a big gap between where buyers and sellers are, and sellers live higher, buyers live lower. So as long as sellers are willing to sell at higher prices, that's great. But at some point, the sellers are going to go, well, I want X price, and the buyers are going to go, yeah, well, I'm down here. I'm about 20% lower because of this event that just occurred. I'm down here. If you want to sell, you better sell it to me here. And that's why you get these big sharp moves down in the markets like we saw in April. Buyers were sitting much lower in April than where they were in March. because of the whole tariff issue. That something like that could happen, and you could see a very swift drawdown in the markets. And this is particularly the case where, again, here's a chart. This is a chart of the Goldman Sachs. They have what's called a retail favorites basket. So this is the basket of stocks that retail buyers are all buying. So they're buying the Palantirs, the Oklos, whatever. That has had the most consecutive days of gain in a row ever on record since they've been doing this basket. So again, there's just kind of summing all this up is when you take a look at the potential triggers for the bear case, you've got inflation ticks up for some reason, which markets aren't really expecting. Fed becomes more conservative. Maybe they next meeting they come out and say, we're going to hold flat. Market's not expecting that. Get an earnings disappointment, especially outside of tech, revenue misses, global disruptions of some sort, energy shock, trade war, whatever. Sentiment breaks for whatever reason. Those could all trigger a fairly sharp reversion in the markets, which is why it's important to just manage risk in your portfolio. And so in that article, I've kind of laid out, several things to focus on. I've written a little bit more detail on it. So if you go to the website, realinvestmentadvice.com, if you go to X, I've posted it there on our X account, the link, at Lance Roberts on Substack. I've posted the article as well at Lance Roberts. It's on Substack. So wherever you follow me, you can find the article. But, maintain some flexibility in the portfolio, right? Focus on quality and balance your exposure. So if you're long a particular asset a lot, you've got a big overweight position in it, trim it back some. If it's doing great, trim it back some. Rebalance your risk a bit. Nothing wrong with holding some cash. Monitor your macro data fairly closely, kind of understand what's going on. Hedge your position, manage your hedging, manage your position sizing. Don't, things that have gotten really out of whack, pull them back into your target position weights. Don't let winners become too large, right? Without reassessing their fundamentals and their risk. Again, trim your winners, let them run though, but trim them. Sell your laggards because they're not working. Rotate your allocations within your portfolio. Add a little bit more defensive now where markets are. Add a little bit more defensive exposure. It's okay. They may lag for a little bit, but they'll wind up paying off for you when the market rotates. And pay attention to volatility. If volatility starts to pick up, that's your ally, right? If volatility starts to pick up, it's a good signal to reduce your risk in your portfolio. So again, that's all laid out in the article. Go by there, and you can certainly go through the whole article. But again, I kind of laid all this out for you this morning, but I think you get the idea. And again, the point is not to pick one case or the other. The point of the conversation this morning is not to walk away and say, oh, well, Lance said that, this is, the markets are about to crash and I just need to, get out of the markets. I'm not saying that at all. I'm saying you've got two cases that you need to be paying attention to. The bull case is valid right now. The bear case is valid in the future. And you have to understand that. And there will be a rotation from the bull case to the bear case eventually, and that is going to happen. It's just a function of timing. So everything that you're locked into right now that's doing fantastic is going to get sold off. It doesn't matter what the asset is. Whatever narrative is driving that particular asset class higher right now is going to end. And there will be a price correction in that asset, and that narrative will go right out the window. It happens every single time throughout history. Just understand where you are. So again, don't pick. This is not pick one case over the other case. It's about understanding both cases and applying both cases to your portfolio today. All right. So hope that's helpful. Again, that article's on the website. We'll be back tomorrow with John Penn for Two Dads on Money. We've got some funny stuff to talk about tomorrow, like how to say no to your wife. We're going to talk about that tomorrow. I have mastered this over the years. I can tell my wife no and get away with it. And I'll tell you how. I'll tell you the big secret tomorrow on the show. Why are you laughing, Brent? Brent says it's not possible. He can't say no to his wife. But if you saw his wife, you'd understand why. She's absolutely lovely. So I wouldn't say no to her either. Anyway, get by the website, realinvestmentadvice.com. Be sure to like and subscribe to the channel. Helps us a lot. We really do appreciate it here. And we'll see you back here tomorrow for 2 Dads on Money. Have a great day.